folks, Dan Frio here at the Mortgage Update. Today is March 18th, and I'm doing an alert. We're issuing a lock because the market's just going crazy. We're down 100 basis points, and again, this is probably one of the biggest moves I've ever seen. So I can't really wrap my head around what's going on. The Treasury is announcing right now that they might step in with a $1 trillion stimulus package. So how that correlates in all this stuff, it should be basically now it should be creating a rally, not a rally, actually a plummeting of the 10-year treasuries. It shouldn't really be affecting the mortgage-backed securities much at all. We saw the yields on the 10-year kind of go way up. And again, this has nothing to do with mortgage rates. I'm just trying to wrap my head around what's going on in the bond markets, because there's a complete disconnect between mortgage-backed securities and the 10-year treasuries. I thought that this was going to be down, driving the yields up. Yields are up, but when the Treasury goes out there and they say we're going to do $1 trillion stimulus. Well, how do they do that? Well, they have to issue more Treasury bills or Treasury bonds to bring in the cash to do this. That's how they fund this system. So when you have you're throwing more supply into the market with not as much demand, you're driving down the prices and the yields up. Well, that's why we went from basically a 0.3 something yield to now over 1.1. That's a dramatic change quick. Why this is going up today makes absolutely no sense. Okay, so now let's revert over to the mortgage-backed securities market. We're down 106. I've never seen that before, and there's no rhyme or reason why this is happening, because the Fed stepped in and said we're going to buy $200 billion worth of mortgage-backed securities. As the runoff occurs, as people sell homes and refinance, we're going to use that money that we normally get and we just kind of pocket. We're going to buy more mortgage-backed securities. So when they issue this stimulus package, it should not affect the mortgage-backed securities market, but it is. So as I talk, watch this number. I mean, basically we started the day off. Let's go back to where we started the day. Mortgage-backed securities were, I'm not even going to look at the Bankers Association press releases and everything else. Let's just get to where we started the day down 3. Now we're down 106. They didn't issue any more mortgage-backed securities. So when you have basically the supply and demand chart is basically this. Let's just look at the demand. As demand goes down for a product, the prices go down. As demand goes up, the prices go up, okay? And then suppliers, they try to produce to get an equilibrium to say this right in here, this is our sweet spot. Right there is where we maximize our profits. Everything we produce is giving us this price. You know, if we oversupply and the demand's not there, we're going to have too much product and we're going to have to start discounting it. So that's basically the supply and demand chart. So why mortgage-backed securities are getting hammered, I think it's a knee-jerk reaction. People are still getting mortgages. The only thing I can think of is now there's a huge signs of recession. They're thinking a lot of people are going to lose their jobs. Now we might be to a bad housing market, foreclosures and everything. They're going to start all over again, kind of like we had 2008, 9, and 10. At that point we were in a recession. It was in an economic recession due to just an overinflated market. We weren't that overinflated, especially in the housing market. They're good loans, stable values. So the only thing affecting this right now is the coronavirus. Okay, let's say it lasts 2, 3, 4 months. At that point, everything's going to come back to normal. Well, as normal as it can be. So I'm not trying to weigh light on the matters, but there's no reason at this point for this to collapse other than they thinking the economy is just going to completely tank. The Fed and the government's not going to let this happen. Housing is the biggest stimulus in the economy. When you're building homes, it helps out every part of the market as well as employment. It has employment figures in there because you're hiring people to do things. It has components such as raw materials, manufacturing. You have to manufacture toilets. You have to manufacture sinks, light bulbs. Think of all the stuff that goes into a house. So the federal government is not going to let the housing market tank again. They're going to do everything they possibly can to curtail this. Okay, so let's not say that everything is completely doom and gloom, because rates are still very good to compare where they were 2 years ago, even 6 months ago. And let's go out and look at a little more further out chart. Look where we are. A year ago, we were down in here. Again, watch this. As this goes up, this is the price of the bond. Rates are coming down. So even May of 20, what year is this? May of 2019. So we'll go back to April of 2019. You know, the MBSs were right here at 96. We're at 100 and, let's see where we are, 101. So it's 400 basis points better. That equates out to at least 1% in interest rates. So it's not a complete gloom or doom. I think a lot of people are taking money off the table because of margin calls. When the stock market crashes, like it's doing, I think, again today, we'll look up that in a second. A lot of people would trade on margin, especially what was going on in the market. I said, pigs get fat, hogs get slaughtered. Take money off the table. Be careful. We're going to have a correction. Never thought we'd go from 27,000 to 19,000. I didn't predict that at all. I thought we would have a little bit of a pullback, but not a complete crash of the system. So right now I locked. We had a window this morning. The market opened up at -3. I kind of saw some triggers that I thought were going to move the market, not this dramatic, but fairly decent. I locked in a short little window, kind of the rest of the loans we have. Let me say this. I just got an email from a client that that emailed me 2 weeks ago, and I said I can get you 3.25 on a 30-year fix, and I'll waive your costs. They just got back with me, and they said, Dan, can I still get that rate in those terms? I just responded back. The best rate right now for that, and again, 2 weeks ago, week and a half ago, is 3.25. It's 3.99. They can't waive its costs. I just went to bankrate.com and a couple other places like Wells Fargo and Chase. Look at that number, just moved again. Sheesh. Their rates, I think I looked at one. Let's do something real quick. One of the largest banks in the country is Wells Fargo. Let's just look at their rates. Right now, I'm looking at 3.99% on the 30-year fixed, right around that area. Don't know what the APR is because there has a lot of different factors in there. So legally, I'll just say it's a 4.3% APR. Could be lower than that. But let's just go to Wells Fargo just for kicks and see where that's one of the biggest lenders in the country. Let's see where they're at. Yikes. So right now they're at, is this today's mortgage rates? Wells Fargo mortgage rates. Yep. 4.625. 4.625. A week and a half ago, I locked most of the clients at 3% on a 30-year fixed. Look at that. I mean, that's a huge jump. Let's just go for comparison reasons. Let's look up mortgage rates just to check and see where we're at with things. Because I always say, shop around, see what you can get. But usually I can beat almost everything out there. So let's take this out and just go to mortgage rates. What comes up? Mortgage rates. Let's go down through. Go to Bankrate, bankrate.com. Let's see the disparity in rates that come up on this chart. A lot of banks are basically just shutting down. They're saying, you know what? We don't want any more business right now. It's too volatile. We're not taking your business. I still am. All right. So let's go CF Bank. Never heard of them in my whole life. 4%. Look at this. Blue Spot. Never heard of them. 4.625. 30-year fixed rate. Let's see the fees. 0.0 fees. First Mortgage Direct, 5.5 with $7,000 in fees. ClickLend, 5.625, $7,000 in fees. So if you can lock in at 3.9 with what I have now, pigs get fat, hogs get slaughtered. That's all I'll say. So if you want to reach out to me, I'd love to help you. If you haven't locked in, I'd highly suggest you call now, or email me. But call 844-775-LOAN, 844-775-5626. Don't email me. Call. I'll take your call, or one of my assistants will take your call. I promise I'll get back with you. but let's get your information. Let's see what you want to do. Right now, a lot of people are losing their jobs temporarily. You're going to have debt. Let's look at paying off a bunch of your debt, skipping 2 mortgage payments. So what normally happens is we'll refinance your loan. You're not, let's say right now you apply now. Okay, it's March. We close you in April. You're skipping April and May mortgage payments. Okay, so that's 2 months you're going to skip. We can also look at consolidating a bunch of your debt. So you're going to condense all that into one low mortgage payment. In most cases, the interest is still tax deductible. So it's, what do you want to pay on an 18 or 25% credit card? Or do you want to pay a 3.99 mortgage? Skipping 2 months right now can be phenomenal. It might be make or break of putting food on your table. So don't wait. Give me a call now. I'd love to help you. I have everybody standing by to take your phone calls. We are taking loans and we're not gouging you like these companies right here. So God bless. I look forward to your phone call. Take care.